Welcome everyone to Richardson Capital Management's second quarter review of 2021. My name is Mark Steele and I'm joined again by our friend Dan Brown. Stocks posted another quarter of solid returns, primarily aided by the continuing reopening of the economy. The S&P registered record highs during all 3 months of the quarter. Other parts of the stock market like small cap, international, and emerging markets also recorded gains. On the fixed income side, bond prices pushed higher for the quarter as interest rates retreated. And then in mid-June, Dan, the Fed came out and spoke. And what did we learn from Fed Chairman Powell?
Sure. So we learned that the Fed is probably going to change their monetary policy stance later this year or early next year. So specifically, they talked about they're starting to talk about tapering their bond purchases. So just to remind everyone, since the onset of the pandemic early last year, the Fed's been buying about $120 billion worth of bonds every month, and they signaled that they're now openly talking about reducing the amount of those purchases. And we expect that to begin probably later this year or early next year. And then we also learned that from their projections for 2023, that a majority of Fed members, so 13 of 18 to be specific, expect interest rate increases in 2023. But again, we expect that when they start to raise increases, it'll be very slow and gradual. So we expect monetary policies to still be accommodative for some time. Then we also learned that the Fed expected that GDP growth, economic growth for this year, 2021, can be as high as 7%. And they've raised that from their initial forecast of about 6.4%. So it's a pretty strong outlook that the Fed sees here for economic growth. And Mark, I think you have some updates for us on economic data points.
I do. Last month we highlighted that job openings, or JOLTS as we refer to them, were at a record high of 8.1 million openings. This month the number of job openings surged to another record high of 9.3 million. So we take this as a signal that unemployment rate should continue to grind lower from its current rate of 5.8%. And our assessment on the state of the consumer, which is about 2/3 of the gross domestic product, is positive. Personal savings rate of consumers is double what it was 2 years ago, and the delinquency rate of credit cards is not only much lower than 2 years ago, but at a record low. It goes back to like 1991. Both factors should support the consumer's ability to spend and boost growth as the economy further opens. Dan, last week President Joe Biden held a press conference on this infrastructure deal. What did we learn?
Yeah, so we learned that a group of 10 senators, bipartisan nature, 5 Democrats, 5 Republicans, approved a $579 billion infrastructure spending deal for traditional items like roads, bridges, rail, broadband internet, etc. And most importantly for the Republicans, it wouldn't increase taxes. So that was a positive set of news. And we learned later in the day that President Biden, along with Democratic leaders from the House and the Senate, want to tie the passage of this bill to an additional multi-trillion-dollar spending bill. So kind of decrease the odds that this will get passed, and it'll be tricky because they can't afford to lose any senators from the Democratic side, given the 50-50 split in the Senate. But it's encouraging news that we're making progress on a deal, but again, passage will be tricky here.
Dan, it seems like we're pretty positive. So what's our outlook for the second half of the year?
Yeah, so we just wrapped up a very solid first half of the year. As we enter the second half, we're still constructive on the stock market. We still see more positives than negative, but we need to keep in mind that we've probably pulled forward a lot of the returns into the first half of the year, with many double-digit returns. So we still see positive advances in the second half, but the magnitude of the gains probably won't be anything like the first half. So we still have very accommodative monetary policy in light of the fact that the Fed tells us they're probably going to reduce their bond purchases later this year and consider raising rates in 2023, if not earlier. But we could experience a correction at any point in time for any number of reasons. Namely, inflation will probably peak sometime in the third quarter, but we still think it's broadly transitory. And on the fiscal side, we could run into some bumps as we try and get this infrastructure deal passed.
Yeah, so that basically wraps up the second quarter for 2021. We'd love to hear your feedback. So if you're enjoying these videos, please like our video by giving us a thumbs up and subscribe to our YouTube channel if you can.